Deepak sir, we have 27 people who have joined. I think we can start now.
Good evening, everyone. So is my screen visible?
Yes,
sir.
yes.
So good evening. So let's look at the performance. In the last few months, we have been underperforming, yes, from the benchmark against the benchmark, or even with respect to the category average, we're in the quartile 4. That's because we are being kind of becoming cautious on the kind of portfolio. We have moved from the mid cap, small caps, we have moved into large caps a bit more. So that's the reason we have kind of been underperforming. We have turned a bit cautious, and then post budget, we have started increasing our allocation to mid cap and small caps. That has also kind of been underperforming because after increasing my allocation, there's been some amount of correction that has happened in the mid cap and small caps. So that's the reason we are kind of moved into the quarter 4. But having said that, now we are being kind of awaiting what this correction was expected, which is already on way now. So this is a welcome correction that's happening in the market, and it's the right time to add stocks into the portfolio. That's where we are kind of tilting our portfolio more towards the mid cap and small caps. We're increasing our exposure in mid caps and small caps, and then wherever we are sitting on cash, we're increasing our exposure in all those portfolios. So that's one change that we have done. And then our view is consistent on the longer term. We're not rotating our sector allocation. We are consistently overweight on sectors like your defense, railways, your capital goods. We continue to be stay invested on these spaces, including the construction, infrastructure, and as well as telecom and little bit of auto. These are the key sectors where we continue to remain overweight, and some of these sectors have been kind of taking profit booking is happening in the sectors. We continue to remain stay invested in this because a long-term view is intact in this space. So we're not changing our view on those sectors. Some of the sectors are trading at excessive valuations, we know that. But having said that, the earnings growth in these sectors are also quite strong. And then that's where the valuation is also relatively justified. But within that sectors, so from the mid caps and small caps, we had diversified and moved into the large caps. Now it's the time to increase our exposure in other sectors as well. Some contrarian views are also kind of building up sectors like your IT. These are sectors we are increasing our exposure now. We are adding into those into the portfolio. So we are buying IT as a sector into the portfolio. That's the right time to add those sectors into the fund. So accordingly, our sector rotation is happening, and then we are confident that in the longer run, we are going to be outperforming the broader markets. So that's where we are going to kind of come back into the performance shortly. So now, talking about the markets have been kind of trading at all-time high, and in the last few days, we are seeing some kind of correction happening in the markets. And globally, the correction is being even much more kind of carnage is much more brutal as of now because of Japan after increasing the interest rates by 25 basis point, and also they have declined on the reduced the kind of bond buying program that has actually led from kind of the carry trade is got triggered, and that's the reason you are seeing kind of sell-off happening. People would have leveraged the positions based on the N. Now, N was available at a very cheap rate. It was available at zero interest rate cost. That's where people had borrowed in the N market and then kind of taken a leverage positions in all the emerging markets and other markets like South Korea, India, and various other emerging markets. Now, when that reversal happens, that's where people have to wind up their positions in all these markets and try to move back. Now, this is going to have an impact in the shorter duration. India, to relatively, is quite immune to this to a large extent. Our fall in Indian markets has been relatively resilient, and we are only long only kind of a portfolio to most of the FIIs, and then many of the FIIs who are kind of done from the greed and fear kind of a perspective. People are holding it from a greed perspective in India. So it's kind of more bullish view on the Indian markets rather than a bearish view as of now. So currently it might look bearish and the entire scenario is looking bearish globally. One side we are seeing kind of the global factors playing out. and also the geopolitical factors also playing out. But on the domestic side, the economy is intact, the earnings growth is intact, the budget has been kind of favorably kind of a mixed bag. We were still kind of protect the growth to a large extent and also kind of do a justification for the coalition parties as well. So that's the stance what government has taken. But taxations were increased as a whole, especially the short-term capital gains and the long-term capital gains were increased. We saw some kind of profit taking happening post budget, but it's going to be short lived. In my view, people will continue to be stay invested in the equities, and then we are not seeing any kind of major rotation from an asset class from equities to moving out into the fixed income or the gold, or for that matter other assets. In fact, the other assets are becoming less attractive right now, and people will have to come back to equities, especially equity as an asset class will play over the real estate, and to a large extent because the indexation benefit is moved out from the real estate as an investment vehicle. So that is going to impact, and then that's going to result in kind of the money flowing back into the equities in a different way. So it's only time will tell. It's going to be short-term correction that we are seeing, impact of all these changes that is impact that we are seeing. But eventually the money will flow back to the equities in a bigger way. Now, talking about US, we are kind of seeing the contraction in the economy that's right now. There is also fears of recession happening, and not necessarily that US will slip into recession, but if the interest rates are not cut, it will definitely slip into recession, but that's the stance right now. So most likely the markets are already kind of priced in kind of a rate cut happening in September. They might be kind of a surprise factor if the rate cut that doesn't happen, then that might be a surprise factor for the markets as well. It can turn negative further. There might be some more selling happening in the equity markets because if the Fed doesn't cut the interest rates right now. But right now, if you look at the bond markets in US, they are already pointing kind of a rate cut happening in the month of September. Now, we may not see a back-to-back rate cuts happening in US. The Fed might cut 25 basis point of rate cut in the first go, and then they might do a wait and watch mode. Eventually, they'll take further more aggressive actions based on the inflation trajectory moving down. So this might be kind of to prevent the economy slipping into recession. The Fed might be proactive in cutting the interest rates by 25 basis points. And on the other international markets, if you look at Bank of England cut the interest rates by 20.25%, so or by 25 basis point. That was actually a welcome move for the European economy. European Central Bank had done in the previous months, and Swiss Bank was the one which started off with the rate cut, followed by the European Central Bank, and now the Bank of England. So the entire European region as a whole is moving towards kind of a rate accommodative rate regime. So that means to say it's going to enter into a bull phase when once this rate cuts happens, the economy is going to recover. So when once that happens, that's where you're going to see the equity markets will be relatively well poised for a further rally into the going ahead. So that's where the markets are right now on the global side. On the China side, we are seeing the economy still continuing to be under pressure. The contraction in the economy is still going to play out. So though the China cut the interest rates and tried to provide the economic stimulus, so that's not sufficient enough to pull up for the country out of the shambles right now. The economy is still under pressure in China. So it would take some time for Chinese economy to recover going ahead. And talking about the geopolitical factors now, it's kind of after the killing of the Hamas and as well as Hezbollah leaders. So it's a kind of Iran has given a kind of indication that it's going to join the kind of the war between Israel. Kind of it's going to be an open war between Iran and Israel now, not just the Hamas. Now it's going to be between Israel and as well as Iran. So that means to say there's an escalation of the geopolitical factor. It may not have any major impact on the Indian markets, some positive impact on the defense space to a certain extent. You might see some kind of demand coming for the defense sector as a whole. That's kind of its early days. We'll have to wait and watch how the order books going to play out for these companies. But having said that, these geopolitical factors are going to increase over a period of time. We're not going to see major de-escalation happening immediately. So this until unless these factors are there, the defense as a sector will continue to play out, and also defense budgets will also keep going up. So that means to say more and more countries will kind of stay invested on the defense side. And as of today, there's a major development in our neighbor Bangladesh, where the army has taken over the kind of control of the entire state as of now, or the country right now. So we'll have to wait and watch how the factors play out, but it's not going to have any major impact on Indian markets as a whole. Some of the manufacturing activities that are happening in Bangladesh will be moved to either Vietnam, Philippines, Indonesia, or to India to a certain extent. So that's one positive side, if at all, to look at it in that way. But having said that, uh, the geopolitical or instability or instability in kind of global scenario still going to play out, and India as a whole, as a having a stable government at the center and kind of the strongest democracy in the world, still have kind of the better premiums, especially the equity risk premium will continue to increase in India going ahead. So we're going to see more and more flows because of this, because India as a country will become more attractive as a destination from the manufacturing perspective, or from that perspective of kind of labor, or from that perspective of kind of the government policies. So all these factors globally are going to play out, and India is going to outperform in the next 5 to 7 years consistently. So that's where the overall scenario is, and I'll run through the what events played out individually on the individual sectors and as well as on the major macroeconomic data points. Now, starting with the budget, if you look at the overall view on the budget was kind of mixed bag. From the growth perspective, it was kind of intact on the growth. The one best part that came out was the management of the fiscal deficit. The fiscal prudence has been intact. We're not seeing any kind of letdown on the fiscal prudence. More importantly, the borrowing has reduced. The government has given a forecast of reduced borrowing despite kind of maintaining a deficit. Now, that's how they are able to manage this, is because of increased taxation. One, because they have increased the taxation on the short-term capital gains and as well as the long-term capital gains. And also the GST, which the inflows on the GST side is also consistently going up. They also kind of gives a kind of cushion for the government to kind of focus on developmental works and then deploy this money into kind of more growth oriented reforms. So that's where the borrowing cycle has been kind of the borrowing amount is also been reduced and being curtailed, are kind of well managed as of now. So the debt to GDP will be kind of stay stable. We are not going to see any increase in the debt side of the overall debt to GDP perspective. Now, more importantly, the capital gains were increased. There was some amount of allocations happening across different sectors that's happening right now. So overall, if you look at auto sector, kind of it was a positive, especially kind of improvement in the allocation of 11 trillion towards the infrastructure and kind of outlay on the connectivity, especially the Northeast region and as well as regions like Bihar and Uttar Pradesh. So that will be kind of positive indirectly for the auto sector, because more and more demand will come, especially from the commercial vehicle side. And that will actually kind of push the demand on the EV side as well, because the electric vehicles as a demand, though the PLI was not kind of continued, but it would be continue or indirectly the sector is going to see kind of benefits there. And also overall, this will improve the demand, and with the per capita consumption increasing, the demand for auto as a sector will continue to be positive. So that's where the sector will be overall positive in the kind of as a sector as a whole. Now, cement, because of so much amount of the impact happening on the infrastructure, the demand for the cement will generally be higher. So overall, the region specific cement players will be in focus going ahead. We'll have to be watchful on the stock specific approach here on the region specific cement companies. FMCG as a whole, there was no kind of change in the taxation for the cigarettes. So that's kind of the cigarette companies are going to gain market share going ahead, and they'll kind of the illicit cigarette will be will lose market share. So going ahead, kind of uh, the leading players like your ITC or the kind of Godfrey Phillips, they'll continue to be in focus on that note. But having said that, with the rainfall improving, the kind of the demand, especially in the rural demand, is going to improve, and budget allocation on the rural development and agriculture is what is be significantly going to impact the FMCG space as a whole. And the self productivity kind of improvement in the productivity of the agricultural reforms, that will be something that is going to be playing out in the FMCG space in the longer run. So it's kind of a long-term measures that is going to impact here. And indirectly, we are going to see the impact on the sector as a whole. More importantly, on the IT services, we are going to see kind of the recipients on the buyback side. So that's actually negative on the IT services, because the taxation has increased there on the buyback. So the capital gains is going to impact on the buybacks as well. So now, talking about the market performance on the global perspective. So if you look at the global returns, so 1 month, 3 months, and the 12 months performance, if you look at India continues to stay kind of an outlier here. We are kind of outperforming the broader global markets. where countries like your Hong Kong or China has been kind of consistently underperforming in the last 12 months or in the month of last 3 months, India is consistently outperforming all the global markets peers. And if you look at the weightage of India is almost equivalent to China in the kind of the MSCI index as a whole, the emerging market index, it's almost reaching that limits of the China as well. So that means to say we might even overtake China also as part of the MSCI index. So that means to say more and more flows from the passive side will also get increased into the MSCI index as of now going ahead. On the domestic market performance, mid cap and small cap continue to outperform the large caps. Valuation wise, we are not seeing any comfort here in the mid caps and small cap. Definitely from a valuation prior from a perspective, the valuations are trading at a stretched levels. Now, this is the kind of price to book kind of data on the mid caps and small caps. If you look at it's trading more than the 2 times standard, in fact, close to 2.5 times standard deviation is what the mid caps are kind of priced in, and small caps is trading more than 2 times standard deviation. That doesn't give the comfort for any fund managers for that matter to stay put into the mid and small. But having said that, in this correction is a welcome correction. So that's where we are kind of increasing our allocation as and when we are buying into the dips in the mid and small cap, because post this we are going to head into the interest rate cut cycle. That's where the bullish the sentiments are going to play out in the markets going ahead. On the sector side, there has been kind of sector rotation that's happening. The typical real estate underperformed for that month, and the kind of the PSU stocks continue to outperform there. But having said that, despite high valuation, the PSU sectors in the last 1 month continue to outperform. IT showed some kind of comeback in the last 1 month with a gain of 12.13% gain. Pharma continued to remain kind of defensive bet, and as well as FMCG was a defensive bet that gained. But overall, there was some kind of sector rotations and high valuation stocks. There was profit booking happening in the high valuation stocks. The sector rotations were happening, and especially in names like your railways or defense, we saw some kind of profit booking happening in the recent last 15 days period post budget. But having said that, the intact is that the long-term spending in these sectors are going to be kind of intact, and that's what drive the sectors in the longer perspective, and we are bullish on these sectors in the longer run. So now talking about specifically about the sectors, consumer durables, kind of we are seeing kind of valuation increasing. For the AC demand has gone up. AC is not now more kind of a luxury. It's now kind of part of your day-to-day consumption part, because of the heat wave across the country. Saw a lot of air conditioner sales happening, and in fact, the refrigerator sales have also gone up. So the durable perspective, the price to book is almost at 2 times standard deviation. The sector is expensive. It's not relatively cheaper, but we'll have to be stock specific from the model perspective. From the oil and gas space, we saw the crude going up to almost close to $90 and then correcting back in the last in the 1 quarter, the entire three months period. So we are seeing kind of crude correcting back to almost $80 and below that now. So that's despite that the windfall tax on domestically produced crude price was also cut, and then there's also kind of expectation that the petrochemicals will also be included under the GST as a purview. So that if that happens, then the prices of the petrol and diesel is also going to come down. That will make the kind of impact the sector in a positive way, and then the consumption is also going to increase, and then the inflation is going to overall come down because of this. From a valuation perspective, the sector is trading at expensive valuation. We'll have to be stock specific here. So as per the model, we have continued to write the model stocks here as per based on the valuation here. Auto sector, the demand for the two-wheelers continue to play out. This quarter is going to be the weakest quarter for the auto space as a whole. So because of the monsoon period, normally we are going to see kind of more discounts getting announced here. Despite the price hikes that happened in the month of April, we saw some kind of inventory buildup that's happened in this quarter. The two-wheeler actually saw some kind of traction, but the two-wheelers were better placed, and kind of the performance was two-wheelers were relatively better compared to the passenger vehicles. The demand reduced in the passenger vehicles marginally, especially in the month of July. But having said that, as we enter the festive season, that's where kind of demand is going to pick up, and more launches are expected to come out in the next couple of months, especially in the names like your Mahindra and Mahindra or Tata Motor. They're going to launch more new variants into the market. That's going to kind of drive the demand going ahead. So from a sector perspective, we are equal weight, marginally overweight on this counter, but the valuation is kind of higher as of now. It's trading more than 2 times standard deviation. FMCG as a sector is kind of, there was some kind of rotation happening into the FMCG space because of the defensive bet, one post budget. Second thing is the early green shoots of rural recovery is happening, but it's too early to take a sustainable position there, but we are almost equal weight on the FMCG as of now. It's trading almost close to 2 times standard deviation from a valuation perspective. Banks, it's kind of a weaker quarter for generally for the banks normally. So because the NIM is kind of under contraction, the borrowing cost is increasing for the most of the banks. We are seeing that kind of the RBI new guidelines, especially the liquidity norms, is going to impact the credit growth going ahead. So that's where the banks have been kind of underperforming as a overall as a sector. We continue to remain underweight on the banking space and entire financial services industry. We have been underweight. We continue to be invested in the kind of selected private sector banks come over the PSU banks as of now. Metal and mining, metal and mining sector had a rally, but post that we are seeing kind of the contraction happening in this space, consolidation happening in this space. There has been kind of incentives all announced for certain selected mining sectors, especially. That's going to boost some amount of demand for certain sectors, and then that would also kind of lead to the improvement in the infrastructure spending as well. That's going to drive the demand. So overall, kind of the sector is also kind of boosted with the kind of environmental regulation that changed. That's going to promote kind of sustainability of the sectors and leading to higher compliance costs and then green initial incentives. So that's going to be positive in the longer run. But yes, the companies have to kind of come kind of clean on the greener aspect of their operations per se. So overall, the metal prices have taken a beating as of now. But with the dollar reversing when the rate cut happens, that's where the commodity cycles are going to see the next rally. That's where we are kind of selectively underweight as of now, but it will remain bottom up when as and when based on the model predictions the model suggestions. Public sector enterprises, they have been the most valued sector as of now, but the most of the action is happening in this space, especially in the space in the sectors like your power, infrastructure, and as well as defense. Railways, to a large extent, even into the utilities aspect. So that's where the most of the action is happening from the government side. Most of the capex spending is happening here. The valuation is obviously about 2 times standard deviation on a trailing basis, and then continues to remain highly valued. Though the fear here is on the execution front, most of the public sector companies are faring better on the quarterly earnings. They're able to execute the orders on time. They're able to meet the demand irrespective of the kind of major hurdles what we used to see in the past. Those are not being seen in the quarterly earnings, and more the tone of the management, especially, is relatively positive on the public sector companies. And most of the leadership, especially in the public sector companies, are more bullish on the entire overall spending of the government and then looking at the long-term perspective. So it's going to continue to play out, and despite having high valuation, this sector will continue to outperform the broader markets. And we are like stock specific, we have been booking profits periodically, but stay invested in this space as a whole. IT, the earnings were relatively better than expected. One. Second thing is the kind of commentary from the management is relatively positive. But having said that, the BFI size spending is kind of the early triggers that's leading to the kind of the positivity in the sector to re-rate going ahead. Accenture results were relatively positive. That actually triggered the kind of positive movement in all the IT stocks, but it's early days. The valuation is fairly valued as of now. That's going to be a contra bet as of now into the markets. We can expect as the rate cut cycle comes in, this will be the sector which can take the leadership position going ahead and start re-rating. As of now, we have remained equal weight and then slowly adding into the dips. We are buying IT stocks with every dips as of now. The pharma as a player, the pharma players are kind of reported a good, healthy first quarter as of now. The domestic formulation companies witnessed healthy growth compared to the US counterparts, the companies which are supplying to the US. The price erosion in US has remained now stable as of now. So we are going to see a single digit kind of a growth happening in the prices. So to that extent, the US FDA issues are still kind of impacting some certain pockets of the company. So that's where we are seeing kind of pressure on certain counters. But having said that, from a valuation perspective, we are in a kind of bull cycle in pharma as of now. The sector continues to tend to outperform. It's trading at 2 times standard deviation, but selectively we are kind of booking profits in certain counters. We are more focused on the domestic formulations compared to the US counterparts, the companies which are exporting to the US counterparts. The chemicals, early days of recovery that we are seeing in the kind of the chemical space. The volume is picking up. The inventory is behind us now. The inventory unwinding has happened in most of the chemical companies. early days of pricing pickup happening in the chemical space. We are seeing a kind of broad-based recovery slowly picking up. We are kind of adding and we are marginally increase our exposure in the chemical space post our last month movement. So we are seeing kind of increase our exposure in the chemical sector. But yes, it's early days, but the global demand has to improve with the rate cut happening. I think the demand will also increase for the chemicals as a sector. So that's where kind of the contrarian view for both IT and as well as chemicals will be the key players that we need to watch out as we come out of this kind of rally, and then this will be a sector which can take the leadership positions in the next rally. Bond markets are indicating that the kind of the gap between the US and the India 10-year yield, the gap has widened in the recent past. And also, if you look at the correlation with, it's almost trading closer to the Brent oil. The correlation is more stronger with the Brent oil as of now. That means to say, kind of with the oil price coming down, the bond yields can move in direction to that. And this is an indicative data that we have actually. So kind of the gap between the US bond yields and the Indian bond yields has to now catch up. So that's where when the US starts cutting rate, India will also start cutting rate. You can also expect that to happen sometime end of this quarter or early next quarter. Both India and as well as US will start cutting interest rate. That's going to be positive for the equity markets as a whole. So whatever correction we are going to see right now is a short-lived. It's going to be for a few days, and then that's where the markets will start coming back into kind of in a bigger way. So we're going to see the kind of markets recovering from the bottoming out from this current correction. So it's a good time to stay invested into the markets as of now in this correction. It's a good opportunity for all the investors to buying into the equities as in this correction basically. On the FI flows, we are seeing both June and July some FI inflows happening. But having said that, this month we are seeing kind of outflows happening. But eventually, when the rate cut cycles happens in the US as well, we are going to see more and more inflows coming into the Indian equity markets. So I'm positive on the FI flows going to remain relatively positive. DIs are kind of consistent to be positive. We are buying into every dips, especially DI. All the DIs are buying into the dips. So that's where the SIP flows are also being quite strong. So that is going to drive the markets going ahead. Despite all this global mayhem, we are not seeing, though the FIs are pulling out money from the Indian markets, we're not seeing a major correction happening in the Indian equities. So that's because of the resilient flows happening because of the retail investor participation, and also we are getting participation from the DIs, especially the NPS and as well as the insurance companies and as well as the mutual fund companies in the form of SIP flows. All this money is getting into the equity market. That's helping in kind of buying in all these corrections into the equity markets as well. The global updates, so the inflation is easing in the US. In most of the economies, we are seeing the inflation, except for Japan. Japan, we are seeing kind of a spike in inflation in the last 3 to 4 months. But on the perspective on the inflation, we are seeing the US heading towards the closer to the 2% mark. So that means to say we are going to see we are heading towards the rate cut cycle as expected in the field, which is what is being priced into the markets as of now. We are already seeing kind of a rate cut happen in European Union and as well as the Bank of England. The inflation has to come down. They're going to be a wait and watch mode right now. So we are going to see more rate cuts coming in this space. As the inflation goes down, we're going to see more and more rate cuts happening. It's going to be a gapped events, not a back-to-back rate cuts that we can expect here. So the main concern right now is US heading for a recession. If you look at the GDP data as of now, it's at 1.3% GDP growth. Yes, the kind of, if we allow the interest rates to remain higher, that's where it's going to impact the economy in a bigger way, because the deficit is also increased and that's impacted the economy in a bigger way. With the higher interest rates, the cost on the borrowing, especially for the country itself, for the US Fed, it's going to be a major challenge, because the way at which the US GDP to the debt to GDP ratio has been kind of increasing or spiraling, these rates are going to come out at the higher rates. That means to say the government will be spending more money on the interest cost servicing the debt. So rather than that, it's more prudent for the Fed to cut the interest rates and bring down the interest rates on one hand. And if you look at the bond market, they're already kind of indicating that the rate cut is going to be kind of priced in already. So if you look at the bond yields from 4.5, it has already dropped down to below 4 levels as per 3.9 levels as of now. So that's a kind of indication that the rate cut is going to happen in the US. But whether it's going to be September or a month later, that's the kind of question. But most likely the markets are kind of pricing in a kind of September kind of a rate cut. It might get delayed if the interest rate, the inflation, the US Fed decides to hold on to the interest rate if the year inflation doesn't fall below that 3% mark. So, but that's going to be negative for the broader market because most of the markets are kind of priced in a rate cut in September as of. The job markets are kind of the job openings have reduced, so there's a crisis that is getting built up in the US market. So all these things factors add up to the point that the US has to cut down the interest rates right now. The unemployment rate has gone up to 4.3%. That's kind of on a higher level. So that's where US Fed will be under pressure to cut the interest rates. Talking on the interest rate cycle, Japan was the country which hiked the interest rates. Barring that, we saw kind of rate cut happening in European Union and UK. US is going to follow suit, and then following UK, US, India will also start cutting the interest rates in the next monetary policy probably. Now, why this correction that's happening is because of the carry trade that's happening, because we are seeing kind of people borrowing money in US in Japanese market at a lower interest rate cost, and that has kind of invested in other emerging economies like South Korea, India, or other markets where people are taken exposure and a leveraged exposure as well. So now with the interest rate going up in Japan, those leverage positions has to be unwound. That's the impact that we are seeing kind of in the South Korean market, or for that matter in the kind of uh, the US, or for that matter even the European markets. That's the reason we are seeing kind of the correction happening. So also it's the correction is not only in the equity markets, also happening in the bond markets also. Despite we are expecting a rate cut happening in the US and as well as European Union. So there's some amount of selling pressure happening in the bond markets as well, because the money was being chasing into the better yielding assets, especially from the Japanese yen perspective. So that's where the carry trade is getting triggered. So it's not going to be a sustainable one, but yes, it's got a kind of decent correction in the global markets as a whole. That would be the kind of trend for a few more days until the market settles down at the bottom level. So kind of bottom levels. Now all the leverage positions will be unwound in the last couple of days. So you're going to see that unwinding of the leverage positions will actually reduce the kind of the outflows happening from all the emerging markets and as well as the developed markets to a large extent. So this carry trade is going to reduce over a period of the short-lived phenomena in our expectations, basically. Domestic update on the budget highlights manufacturing got the major impetus, especially electronic manufacturing or the defense. The defense outlay was around 9% increased year on year to 1.7 trillion. Overall, capex was very increased to 16% year on year to 11.1 trillion. That was kind of flat from the interim budget, but from the interim budget perspective, it's being kept flat. But overall, from a year-on-year perspective, there's a 16% year-on-year increase. Railway capex was up 2% year-on-year to 2.7 trillion. Road safety and then the passenger kind of amenities will be increased, while rolling stock was up around 4% year-on-year. So it's mildly positive for the railway sector. That's also kind of positively that's one of the reasons why railway stocks kind of corrected a bit post the budget. But having said that, the long-term story is intact. More and more Vande Bharats will be introduced. We are going to expect news from the railway ministry saying that they're going to include the golden quadrilateral into the freight corridor and as well as the passenger movements, especially in the form of the bullet trains or in the form of Vande Bharats. That's a positive move for the railways for a period of time. We are also seeing more impetus coming on the energy transition side, especially the energy conservation and energy self-reliance on the energy side. That's where the sectors like your power, or for that matter, oil and gas space, especially into the kind of green energy, kind of renewable energy, that's going to get a major impetus from the markets, especially from the budget side. And on the NBFC side, we are seeing kind of the housing spending or the PMIY spending on the rural or the urban housing. That's going to take a positive impact for the sector as a whole. We are seeing more and more kind of the stamp duty also kind of moderated, especially uh, is going to be expected to be moderated going ahead. That's going to be positive for the actually kind of affordable housing. And overall, if you look at the MSME credit growth is going to be increased. So that's where you're going to see the manufacturing activity to pick up steam over a period of time. And that's going to be healthy for the entire MSME space. And the custom duty increase on the gold, that's kind of the reduce on the gold. That's actually negative for the kind of the gold financials, because the value of the gold itself is dropped. So that's the reason it's going to impact all the gold financing companies. So the banks, we are seeing kind of the credit guarantee scheme on the MSME is actually kind of positive, and then we are going to see more loans issued to the MSME as a whole. So that sector, that part of the banking space is going to see more traction coming in. But overall, banking as a whole, if you see, the credit growth itself will be kind of trimmed down a bit because of the liquidity measures what RBI has introduced. So the banks will be more cautious now on lending side. But on the borrowing front, most of the banks have to increase the borrowings. The cost of borrowing will go up. That's also going to impact the NIM to a certain extent. We are seeing the CASA being kind of under pressure for the banks. So it's overall negative for the banks as a whole. But from the budget perspective, it's kind of going to lend to the MSME spaces, and also kind of line of credit has been allocated to certain strategic sectors where the government is kind of focused upon in the budget spending for the longer run. So capital gains, I think the news is already been priced in, and then kind of we are seeing kind of more and moment of data that's already there. I will be skipping this slide. We are seeing kind of the long-term capital gains also changed, and as well as the short-term capital gains also kind of impacting the both were increased. So kind of that's actually kind of negative for the equity as a asset class. But yes, from the real estate also it's been negative because people who are investing because of the indexation benefit that has been removed. So the money will flow back to equities instead of having real estate as an asset class. If people were trying to block real estate as an asset class, now they're trying to focus on the equities as an alternative assets as well. So that's kind of a positive in the for the equities in the longer run. The GST collection has been robust, 1,82,000 crores. So that continues to remain robust. And we are seeing the increase in the GST collection year on year. That's positive for the government and as well as for the growth reforms in the country. The PMI has been quite robust. We are seeing the kind of both resilient PMI from both manufacturing and service sector. So that's kind of, it's a kind of measure that the earnings are going to remain positive in the longer run. Both the GST collection as well as the PMI data is indication of the earnings, the corporate earnings. So that's going to be positive, and that's also kind of uh, reiterates the valuation for coefficient for India remaining more at the premium end compared to the global market. So India will always trade at a premium valuation. You'll never get India at a cheaper valuation going ahead, the shorter duration at least. So if you look at compare the global economic route, what is happening, and compare India on the other hand, India is kind of better off, especially on the economic front. That's the reason we are going to see that economic risk premium dividend playing out in the Indian markets. Uh, Outlook, inflation is expected to come down, and the US inflation kind of reached below 3%. It's going to improve further here from here on. It's going to fall below 3%. But on the domestic side, if you look at the rainfall has been kind of very sporadic in certain parts, we are seeing kind of flooding happening, and some excessive rainfall is also expected in certain pockets of the country. But overall, if you look at the rainfall, is kind of almost on the higher side relatively to the longer term expectations. So that's where we are seeing kind of the unsporadic rainfall can also impact some of the vegetable prices, or the food inflation can also be impacted because of that. RBI is maintaining adequate liquidity. Interest rates, we saw Bank of India, England cutting interest rates. Fed can cut interest rates, especially the markets are already priced in a 25 basis point cut in kind of September. Any surprise factor from here can be negative for the markets. The bond markets are already kind of tending that the rate cut is expected shortly. So we have kind of the yields are already below 4% in the US. And India, the yields have been remaining stable. So that's kind of the divergent view what we are getting from the Indian markets. But yes, in the longer run, we are seeing the yields coming down below 7% right now. It's come to 6.9. It's too early for the Indian bond yields to react sharply, but also the currency is also kind of on the negative side. The impact of currency is also seen partly here into the bond markets as well. Equity markets, kind of we continue to remain bullish and constructive on the equity markets because one, we have a stable government, growth-oriented government, the reforms-oriented government, and as well as kind of we are seeing kind of the economic dividend playing out in India. India as a whole, as a country, is standing across global markets. If you look at it, it's playing out in a better way for economically. So that's all these factors are going to play out in the equity market, reflect in the bull market in the equity markets for the next 3 to 5 years. We continue to remain constructive on the equity markets, and especially mid caps and small caps will play out have a major play out in this rally going ahead. With the rate cut happening, we are going to see the next leg of rally happening in the equity markets. What are the key risks? Any geopolitical escalations with now Iran and going on war head on with Israel, that's a negative aspect. But for if any escalations further in the Middle East, that can be negative, especially from a crude oil perspective also. Any further other countries joining into this war, that can, which is very unlikely to happen, but we never can say, because now Iran has joined along with Hamas, and then which were kind of uh, which was a kind of a negative aspect in that region. But having said that, the disturbance in the region will not be sustained, not be tolerated for longer term. And obviously, not many other countries are very keen in joining this war along with Iran, or for that matter with Israel as well. So most other countries in the region are kind of neutral to this situation as of now. Any spike in inflation, which is very unlikely, only the food prices can go up short term. It's going to be short term lived, and I'm sure kind of over a period of time, this inflation will also play out and come down. And then with the interest rate cycles at the current levels where we have, the inflation is clearly heading lower. And rate hike in Japan has kind of triggered the kind of the the carry trade especially. So that's where we are seeing kind of correction happening in the both bond markets and as well as the equity markets marginally. But having said that, it's going to be short-lived. We're not going to see sustainable downfall in the markets. So it's going to be short-lived, and the markets will react positively going in the near-term future. Any delayed rate cuts from US, that's going to be negative for the markets. So kind of the markets have already priced in a September rate cut. Any further delays from here on, kind of, yes, can be temporarily negative for the markets, but not necessarily it's going to be a significant fall in the markets going ahead. So that's the update from my side. Any questions would be more than happy to answer.
If you have any questions, feel free to ask or write your questions in a chat box.
Anybody, any questions?
Deepak, we have two questions in chat box.
So I think FlexiCap is the best fund to invest in right now, because the correction happening in the markets. So it's a good time to enter into the mid caps and small caps. So I think FlexiCap offers that in a bigger way, and we are increasing our exposure from the large cap and mid cap into the mid and small. So we are moving away from the large caps to a certain extent. We're reducing our exposure in large and moving into mid and small. So that's where we are kind of positive on the FlexiCap as a whole as a category, and we are implementing the same in the multi-asset also. We are increasing our mid and small exposure in the category in the multi-asset fund as well. So both these funds will be kind of relatively kind of aggressive from a perspective. So that's going to play out in the longer run and give a better returns going there. So will there be a world war? Will it affect the Indian market? If it's a world war, definitely it's going to affect the Indian markets. I don't see a reason why world war is going to happen, because just because it's Iran has joined against Israel, The other countries in the Middle East are not being kind of neutral to this. They're not very keen on to this. So joining this war as of now. So I don't see any kind of reasons why the world war is going to start. But yeah, if it's we are entering into a world war kind of situation, obviously all the global markets are going to collapse. Yes. Can we expect quick returns expected from infra and manufacturing sector? Yes, infra and manufacturing are poised for the better returns. There are also other sectors which can also give a better returns as a power as a whole and energy as a whole as a theme is also going to play out. Not only infra and manufacturing, energy as a sector will also play as a sector will also give a very good return. So what is your opinion on the current market for equity schemes? I'm bullish on the equity markets because though this the time to buy into this dips, all these corrections are welcome correction into the markets. So it's an opportunity for investors who have missed out in the rally. It's the time to stay invested into this, and then it's going to kind of give very good returns in the, at least next 1 to 2 years. Interest rate down possible in the current months. Yes, as of now, the markets are expecting a September rate cut, but any delay further from that can be negative for the market short term, which will be short term. But yes, interest rates are going to come down. I can't exactly tell when it's going to happen, but the markets are kind of pricing in September rate cuts. The commentary from the US Fed also kind of indicated towards a rate cut, and if you see the European markets or the Bank of England, they've already cut interest rates. So going by the standards, I think the US will also start cutting the interest rates. And the major surprising factor that might be happening is if Trump comes back to power. And next year, we might see some kind of relief on the Ukraine and Russian war. That's also going to add to the positivity to the markets as well. So these are some of the things which can improve the equity market performance going ahead. So these are the factors which will be positive for the markets. Yes, manufacturing theme will be a good deal for the next 2 to 3 years, as you suggested. Yes, it's definitely yes. Manufacturing will be a good theme, and नया NFO करने वाले हैं क्या? So yes, we are doing a NFO, so which is going to launch shortly in the month of September end or early October. That's where the NFO will be launched. It's going to be on a sector kind of a fund. So we'll be coming out the name shortly. 3 to 5 key points to look for while investing in stock/mutual funds. One is sustainable kind of earnings is what very key for investing in any sector or any stocks for that matter. If you look at any stock that if you want to pick into the portfolio or into investing, you need to look at the consistent earnings of the companies, the management qualities, the debt to equity on the balance sheet, the business model is intact, long-term business model with respect to their own competitors, are they doing good? These are some of the things you need to look at. The mutual fund, what kind of stock picks are happening? What is the investment strategy? These are some of the things you need to look out for the longer term. Shorter term trends, a lot of mutual funds do trading and then kind of show higher returns. But yes, you need to look at the long-term investment philosophy of the companies. Which theme is good for invest post budget? I think the power, railways, your manufacturing, these are some of the themes that are going to play out. Defense, your capital goods, all these other sectors which are kind of playing out going ahead post budget.
Any more questions? Okay, no questions, then we can end the call. Thank you, Deepak. It was very insightful session. Thank you, everybody, for your time. Thank you.
Thank you. Thank you, everybody. So thank you very much.
Thank you, sir.